Joe, you take a look at that economic data that we got this morning. I guess some of the economic data we got over the last couple of days here, and that seems to be the ammunition that I think Jay Powell would want to see to keep hiking interest rates.
Well, certainly, and I think what we're seeing is just continued momentum in the economy. I think some of this was just the echo waves of the pent-up demand. We see that in parts of housing, we see that in the auto and the consumer sector, but it's clear that the labor market is cooling. I think the big question is how much does it need to loosen? Because if it does not loosen a little bit, we're still going to have an inflation problem at year end.
Why do you think, Joe, that we haven't seen much more looseness in the labor market, given just how aggressive the Fed has been, and for that matter, just kind of the withdrawal, or at least I guess the pause, if you will, of other forms of stimulus coming out of the fiscal side of the equation?
It's a great question. I think ultimately I would bottom line it to say that the Federal Reserve, despite being very aggressive, is not that restrictive. They only have the Fed funds rate. Yes, it's above the rate of inflation, but it's not 200 or 300 basis points like we've seen before recessions. And I don't even have to make an argument that R-star is higher, which it very likely is. So I think it will take time. The labor market is cooling, so that's a positive. But nevertheless, you still have a material imbalance in labor supply and labor demand. And I think it's naive to expect that we're going to see a magic fall in wages without some further tightening the Federal Reserve is going to have to do.
We have started to see, I guess, some softness in consumer spending. I know there's been we've talked a lot about that rotation into services and other things, but some of the recent reports we've gotten seem to suggest that maybe we're not as spend crazy as we were maybe a year or so ago.
Certainly. I mean, I think we're still seeing some of that rebalancing out of the goods into the services, travel, leisure, and so forth. That will continue to work its way through the system. But, generally speaking, consumer activity is not a leading indicator. I know it's 70% plus of the economy, but it comes down to business investment, which is then tied to the job growth, and then that ultimately drives income and consumption. So really, if businesses continue to expect very strong demand, then they're going to continue to hire. And so I have not seen that dynamic shift, and that's why we've seen the Federal Reserve terminal rate continue to rise over the past year and a half. And I don't think they're fully done. I'm not saying they're well behind the curve. I think we're getting closer to the end of the tightening cycle. But I don't think the Fed cannot claim that they are very restrictive, because it's just simply not true when you look at relative to inflation.
And we've heard that from some Fed members, and I think the Fed minutes sort of revealed that discussion behind closed doors. Yes. Of course, looking forward, as you know, Joe, we get the Fed meeting, the Fed decision, I should say, on the 26th of this month. The next one is in mid-September. Then, of course, in between that, you get Jackson Hole. What type of communication do you think we're going to get over that stretch? Do you think it's going to be as unified as it was over the past year?
I think so. I mean, again, central banking is also a really tough job, and so they are trying to be forward-looking. At the same time, they know that some of the indicators that are the strongest in the economy give you very little lead time before a recession or even a material slowdown. Consumer spending, jobs market, they actually don't lead the business cycle, and so I think they're trying to talk to businesses. They're trying to calibrate. They're looking at the financial markets and inflation expectations. I think that all leads them to some more modest tightening ahead, and then at that point, it's going to be to see, how much still imbalance do we have in the labor market. If we do not see some of the vacancies come off, then we're going to have an issue in 2024 in terms of still elevated wage growth.